Disclaimer: this is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism. All right, with that out of the way, let's dive right in by looking at a truly staggering number: $3 trillion. That is Tradeweb's massive average daily volume for the second quarter of 2026. I mean, this figure alone sets the entire stage for our teardown today. We're looking at a platform moving an unbelievable amount of capital every single day, hitting absolute record-breaking activity in rates, credit, and equities. But as any seasoned equity analyst will tell you, in financial markets, sheer size definitely isn't everything.
So looking at these numbers, we have to ask the hard questions. Does record-breaking volume actually translate into bulletproof pricing power? Is this sheer scale a true economic moat, or could it be masking some pretty serious underlying structural headwinds? Because look, when you're processing $3 trillion a day, the margins on every single transaction, no matter how microscopic, dictate the health of the entire enterprise.
Welcome to this explainer. Today, we are putting on our analyst hats to perform a rigorous, data-driven teardown of Tradeweb. We are completely stripping away the market hype to focus purely on the public filings, the raw data, and the underlying market microstructure. We'll examine the undeniable triumphs of their top-line growth, but we'll also dig into the hidden red flags buried deep in their fee structures.
Here is our methodical agenda for today. Section 1 covers top-line growth and volumes. Section 2, capital returns and dividend safety. Then we pivot to a major red flag in Section 3, fee compression. Section 4 explores their automation moat, AIX. Section 5 digs into market microstructure and information leakage. And finally, Section 6 is our final analyst verdict.
Section 1, top-line growth and volumes. Now, what's really interesting when we break down the financials is the broad revenue growth across their diversified platform, which totaled $558.9 million for the quarter. You can see rates driving the bulk of the revenue at $228 million, up 11.4%. But check out that bottom row, a massive 22.8% surge in market data revenue, completely driven by strong institutional demand for their proprietary pricing and analytics. However, there's a critical piece of context we have to note here. Overall, top-line growth actually decelerated, dropping from a scorching 21% pace in Q1 all the way down to 9% in Q2.
So why the sudden drop in momentum? Well, management explicitly attributed this sequential deceleration to what they're calling normalized volatility. Essentially, that frantic, high-velocity trading pace we all saw in early 2026, it cooled off significantly. The markets finally caught their breath, and as a result, the transaction volume and therefore the top-line revenue growth came right back down to earth.
Section 2, capital returns and dividend safety.
This business boasts $1.1 billion in trailing free cash flow, which is fantastic, but a massive green flag for how they actually allocate that cash is this new $500 million share repurchase program authorized for 2026. This kicks in right after their previous $300 million program is exhausted. In Q2 alone, they aggressively bought back almost $189 million worth of stock at an average price of roughly $99. This gives management immense flexibility to support the stock price opportunistically.
And alongside those heavy buybacks, Tradeweb is paying a regular quarterly cash dividend, currently yielding around 0.52%. Now, yield is nice, but what we really care about as skeptical analysts is safety. And Tradeweb has an incredibly low dividend payout ratio of just 12.33%, backing its 56-cent annual dividend per share.
The crucial takeaway here is that this remarkably low payout ratio means their dividend is essentially bulletproof. They're barely even scratching the surface of their earnings to pay out shareholders. And this is exactly what you want to see, because it leaves plenty of retained free cash flow to aggressively fund their own internal tech investments and software capitalization, which is absolutely vital if you want to remain a dominant technology-driven trading platform.
Section 3, the red flag, fee compression.
But of course, it isn't all sunshine and stock buybacks. It is time to shift to the bear case and uncover the biggest red flag buried in this earnings report: capture rate erosion. The data shows the average variable fee per $1 million traded. Basically, this is exactly how much Tradeweb captures for every $1 million that actually passes through their system. And here's the rub. Despite total volumes hitting record highs of $3 trillion a day,
The actual variable fees they collect are dropping significantly across almost every single asset class. Rates are down 9.4%. Credit is down 8.3%.
So why is this happening? It comes down to a structural shift in what clients are actually trading. As noted in independent analyst reviews of the quarter, the product mix is heavily skewing toward much lower margin segments, like passive ETFs and algorithmic portfolio trading. This relentless fee compression means Tradeweb basically has to run faster and faster on the volume treadmill just to maintain its revenue growth. The volume goes up, sure, but the slice of the pie they get to keep is getting thinner and thinner.
Section 4. The Automation Moat, AIEX.
So how exactly does a company survive a shrinking margin environment like that? Well, by making your clients completely structurally dependent on your ecosystem. Just look at this incredible adoption curve for their automated intelligent execution platform, known as AIEX. Back in 2020, it handled about 25% of institutional trades. Fast forward to the first half of 2026, and that number has rocketed to 45%. This isn't just a fun software feature. It signals a highly sticky, structural shift away from traditional phone-based voice trading towards algorithmic screen trading. Once a major institution integrates this automation into their daily workflow, the switching costs become astronomically high. Furthermore, they are aggressively expanding this economic moat through artificial intelligence. They recently launched Terra, which is a generative AI-powered research assistant embedded directly into the daily workflow of institutional credit traders. By providing proprietary analytics right where the trader already works, Tradeweb is doing something brilliant. They aren't just an execution venue anymore. They are slowly becoming the indispensable operating system for the entire trading desk.
Section 5. Market Microstructure, Information Leakage.
Now, let's get deep in the weeds of market microstructure. We're translating a fascinating, highly complex academic paper that Tradeweb's own researchers actually published regarding their execution quality. Think about it. When a massive institution wants to trade, they can use an electronic request for quote, which basically blasts their trading intention to the whole market to drum up the best price. Or they can do a bilateral voice trade, which is a quiet, private negotiation over the phone. Which one is actually better for the client? To really understand the hidden risks here, the researchers broke down the exact life cycle of a trade. They isolated this tiny, microscopic time window between Step 1, when an electronic RFQ is privately accepted, and Step 3, when the trade is finally published to TRACE, which is the public market tape. What exactly happens in that middle window? Well, the researchers found that the electronic broadcast actually causes prices to move against the trader before the public even knows the trade happened. By shouting their intentions to the whole market, traders were leaking sensitive information, allowing the broader market to react prematurely. But importantly, the impact of this isn't uniform. The data shows that this information leakage is relatively harmless if you're trading highly liquid bonds. The market is deep enough to easily absorb the broadcast. But if you are trading low liquidity bonds, broadcasting an electronic RFQ acts exactly like a flare gun in the dark. It significantly amplifies adverse, same-direction price movements. So the automation in this specific scenario actually hurts the trader by moving the market against them. And honestly, this brilliantly illustrates exactly why Tradeweb's engineering moat is so deep. They didn't just publish this research to point out a flaw in the market. They used this exact microstructure data to develop highly advanced trading protocols like Snap+. Snap+ is engineered specifically to give clients the competitive pricing of a broad electronic market while mathematically protecting them from this exact type of information leakage and front-running. It's genius. They identify the market inefficiency and then they sell the proprietary software solution to fix it.
Section 6. The Final Analyst Verdict.
All right, after evaluating the top-line financials, those structural headwinds, and their execution technology, it is time to synthesize this data. Objectively, we are forced to weigh two incredibly powerful opposing forces. On the bull side, you have an expanding total addressable market, highlighted by 13.9% international growth and absolutely relentless workflow stickiness driven by the AX platform. They are undeniably capturing more of the market every single day. But on the bear side, you have that pricing power erosion. The harsh reality is that product mix shifts are steadily compressing their profit margins per trade, pulling overall average variable fees down over 7% year over year. As an investigator of these financial statements, I've laid out the raw data, the hidden mechanics of the trade, and the strategic moats for you. But now, you have to do your own homework. The volume models clearly point to an expanding, highly cash-generative business, but those fee compression flags? They suggest a margin storm is brewing on the horizon.
So I'll leave you with this. Is Tradeweb an unstoppable electronification juggernaut that is destined to own the future of trading, or are they a giant slowly, quietly losing its pricing power? Which side of the trade are you on?